Valuation is one of the most misunderstood parts of fundraising, and getting it wrong can stall your startup's growth. In this episode of Capital Compass, we explore how valuations are set, what really drives them, and how founders can think smartly about dilution and negotiation. Let's talk about startup valuation and the art and science behind the valuation. In this episode of Capital Compass, we are unpacking one of the most misunderstood as well as emotionally charged topics in fundraising: how startup valuations are set and what they really mean. What is a valuation really? Let's start with the basics. A valuation is the dollar amount assigned to your company at the time of fundraising. It can either be pre-money or post-money. When we're talking about the pre-money valuation, it is the valuation before the investment. When we're talking about the post-money valuation, it is pre-money plus the investment amount. But here's the truth. Valuations aren't about the intrinsic worth, they're about investor demand. So a valuation is equal to negotiation plus narrative plus market sentiment at the time. What drives your valuation? Now, the valuation is a combination of a couple of factors, as we said. It's the investor sentiment, it's the story strength, and the supply and demand. When we're talking about the investor sentiment, it's about, are the investors really excited about your space? Has there really been a recent exit or trend in your vertical? This brings us to the story strength. When we're talking about the story strength, it means, do you clearly articulate the problem, solution, and your go-to-market strategy? And do you show a credible path to a big outcome? This brings us to the market sentiment we talked about, which is actually the supply and demand factor. Are there multiple investors circling you at once? Do you have momentum and urgency in your fundraise? Investors aren't really pricing your company based on spreadsheets alone. They're pricing it based on perceived potential, the comparables, and how much heat you're generating in the market. Let's talk about the mistakes that founders make around evaluation. Valuation mistakes are common and costly. Here are the 3 to avoid. First and foremost, over-optimizing for the highest valuation. It sounds great but makes future raises harder if growth doesn't match. Secondly, not understanding the dilution math. Know how much ownership you're giving up. Always model dilution at this and future rounds. And thirdly, chasing hype over fundamentals. A high valuation without traction can backfire, leading to down rounds in the later stage. So what really is the right valuation for you? There's no single right number, but here's a framework that can help guide you. Raise the capital that you need for 18 to 24 months. Offer 15 to 25% of equity in early rounds. Pick a valuation that you can grow into, not just talk up. Think of valuation as a tool and not a trophy. Choose a number that supports your narrative and gives you room to build. To sum up, the startup valuations are part data, part psychology, and heavily influenced by market dynamics. Focus on building a credible, investable story and know what you're willing to trade to fund the journey. This is the Capital Compass series. New episodes drop in every few days, so do stay tuned in for more. And if you're raising, do share your pitch deck at pallavisegel.com/submit pitch deck for potential support, feedback, and review. Thank you.